Beautiful autumnal morning, but still quite mild. Okay, now I'll just want to revisit some issues from last week, just at the end of the set of slides to talk about the board of directors really briefly. I'll just want to flag those because it sets us up for discussing the relationship with corporate finance. And then we'll come back to the discussion of the board of directors, etc., in the context of the control of the corporation, which is coming up next week. Okay, but let me just go back to them. So there was a set of slides, the firm in law. Okay. We finished up with the discussion of the incorporation process, and I told you that there's examples on the website, and you can look at these links as well too to see how you go about it. And if you want to incorporate a company in Japan, there's some really good information available from JETRO. Okay, so when we create this legal entity, this undying legal entity that is the company, that is allowed to own assets, be in control of assets, that can enter into contracts, binding contracts, for example. Of course, we can't just set and forget it. We need, it has to be actually controlled and be accounted for by real living humans, but those people can change. So the great advantage of the corporate form is that it creates this eternal ein hojin kind of thing. Not necessarily. Sometimes it has a time limit, but not really, not very often these days. So it creates this everlasting institution, but which has great potential fluidity in terms of all of the key stakeholders. So the owners themselves can change, and that's what we'll talk about soon when we talk about the relationship of the company to financial markets. Publicly listed firms and private firms, the ownership can change while the business continues in a stable way. The day-to-day employees can change while it continues. The managers and the key governance members as part of a governance structure can change. And in fact, it's a very good thing that they change regularly. Otherwise, you can get a rather bad running together of private and company interests. So the directors might forget that it's not their own business and that they're just there to protect the interests of the owners and the other stakeholders of the firm. So all of this is reflected in law in countries, a range of countries, a range of different laws, but pretty straightforward common requirement that you specify who is actually in charge of the company, and you specify it in terms of roles rather than individuals in law. And then subsequently, there's just a notification process for identifying who holds that role at the time. In short, it's a constitutional project. And this is something I think that's so often overlooked. The structure of the company and this notion of the separation of the role from the individual person who fills it is a revolutionary idea in human organization. Now, it's become absolutely normal, of course, in constitutional democracies. We're in the midst of a US election. Come November the 3rd, we'll find out who will be the next person who gets to sit in the Oval Office, you know, because it's oval. The president's office in the White House. It's very clear that the role is separate from the person. And so it was actually corporations that first established this principle. Later on, it actually carried over to the state. So if we think of the foundations of democracy, ironically, we should think of them as actually starting in the private sector, in companies. But there's an extra layer of irony, because we see that, say in the English case, the creation of a company in the first place normally needed what we call crown assent. So it needed the approval of the king or the queen of the day. But then the governance structure actually separated the rights of the company and the assets of the company from the people who of that particular time happened to be in control of it. And it did so by specifying a series of roles. The board of directors is a common structure. Okay, and so we see the chairman, or kaicho, sometimes referred to as chairperson these days, but so that the chairperson is really first amongst equals, and very often was only responsible for one meeting. So legally, all the members of the board of directors are actually equal and have equal responsibility. Now, many of you will be thinking about, so what about the role of the CEO? Well, the CEO is an employee. The CEO is the top employee of a management strata, but you can draw the boundaries of management wide, or you can draw them narrow. You don't have to draw them at all, actually. You don't have to distinguish between like officers and other ranks in the military, but you do have to have a chain of command. So organizationally, legally, we'll always see that there is an identification of who is actually responsible for this. So when we talk about these issues of risk, reward, and liability, understanding this basic structure is absolutely critical. Typically, the law sets a minimum number of board members, okay? And the board becomes accountable in law for the actions of the incorporated entity. And whether that can be a university, if it's like a Gakuhojin, an educational foundation, a for-profit company, or whatever. Notably, in the partnership arrangement, a partnership by definition is the equivalent of the board of, it is its own board of directors. All the partners are considered to be equal. You may see partner and senior partner, for example, in the case of law firms and accounting firms. That's actually on the management side. It's not actually on the governance side. There's a distinction here. All partners have what we call an equity stake and equal ownership in the partnership, but then the sediment partners are also entrusted with some day-to-day managerial roles, and we'll clarify that later. So what we see with the incorporation, hojinka, okay, or the foundations of a company, it's typically under a national or regional laws. And there's been a lot of creating of common law. So in my country, in Australia, which was created from the federation of 6 states and 2 territories, plus a couple of other little things that are not self-governing. We used to have incorporation on a state basis. Recently, they've moved towards a uniform national corporation register. So in a sense, the front office is still at the state level, but it's now common uniformly. And that was much more efficient for companies and much better for everyone trying to track down a company and hold them responsible as well too. So you can find out who's through a common register. In fact, there's a link on the website there. You can check out who have been directors of a company. So if you're chasing a company for money, you know who to chase, okay? So the legal role, it carries the burden of maintaining the value of the organization and public trust in the organization. Now, incorporation itself gives, depending on the country, some directors some protections from legal liability, but it varies enormously country by country, and we find many business executives can get themselves in trouble when they assume that they're not liable for the actions of a company in one jurisdiction, maybe the home jurisdiction. They go somewhere else and they suddenly find themselves being arrested, for example. This has happened to European executives who've gone to the United States. We've seen executives arrested in places like Dubai that didn't have the same notion that directors had only partial responsibility. Very importantly, though, precisely because it's a little bit unclear, unless you look carefully at case law, how far directors have responsibility for the actions of a company, directed by the Torishimari Yakuin. What we see is that very often when someone sues a company, they also name the directors in a legal action. One of the reasons for this is precisely limited liability, we're going to talk about later on. That if the company actually ends up having no assets and you're trying to get redress, trying to get compensation from a company, you have to get hold of somebody, okay? And this is going to be one of our key themes today. We're going to want someone to take responsibility and try and make them bear the liability, bear responsibility for, say, the losses of a company or the costly impacts on other people from some of the company actions, whether it's pollution, whether it's burning hot coffee that scolds someone, in a McDonald's, someone slips on the floor and is injured, all of those kind of things, okay? So it can be quite a risky thing to unthinkingly become a director of a company because it sounds kind of cool, and that they give you a bit of monthly pocket money, sometimes quite a lot of pocket money. Colleague and friend of mine was at Dorsetshire Business School, said he was quite surprised when he came through the E+G that one of the professors is a director of a major company in Japan, prominent. He's an accounting guy, and his director's fees for the year were over 1000 and that was actually more than my colleague was getting paid by the business school. So I thought, well, okay, rightio. And this guy's got 2 other of these things too. So he's probably making 2 to 3 times as much money through holding the directorships as being a professor. And I have spoken with a couple of KO professors over in the Faculty of Commerce and Business and Commerce. I don't know why they don't just make it one name in English. Never quite got the point of that. No one can seem to explain the business and commerce distinction in their minds, but KL seems to be quite relaxed in their professors being external directors. And indeed, one of the professors, a nice guy over there, told me that he actually has a desk in an office in Dentsu, and it's 3 days a week at Dentsu and 2 days a week at KL, and Dentsu pays him more. I guess that's why he's also got a very nice apartment with a view over the sea in Hayama. Very, very nice. So, of course, for directors, it can be a really good deal until you get sued. And this is an old statistic, but it's a really striking statistic that even before the kind of the new wave of trying to hold directors responsible for companies, about 40% of them in the 1996 survey, directors said they'd been named in a lawsuit against a company. Being named in a lawsuit is really, really messy. You have to get legal advice for a start. So you start paying for lawyers. You can be called upon to go to court. You may be found personally liable. At the very least, you can have to spend a fair bit of money. And unfortunately, corporate lawyers charge much more than criminal lawyers. Criminal lawyers, the market rate is a lot lower because they know your average client can't pay very much. And it can drag on for years and years and years. So, people often say that their life is kind of on hold while they sort these things out. And I've heard of executives in Japan, for example, that if they get pointed, I was told explicitly by one guy, Hitachi, that when he was elevated to being on the board, that he shifted the family home into his wife's name, and created a whole bunch of new bank accounts and put their savings into his wife's name, just in case by chance. And there's no reason to think Hitachi is something bad. It's actually a very reputable and outstanding company doing great things. But there was always the possibility that somehow he might be found liable for something. And we'll come back to under conditions where it might. So interestingly, the shareholders themselves can take legal action against the directors. And we see that the directors, as members of the board, are the pivot point between the shareholders and the legal entity that is the firm, the manages day to day. So effectively what happens is that the shareholders elect the directors to control the company, and then the board of directors supervises, indeed conducts, the most senior appointments. So particularly the appointment of the CEO, so the chief executive officer, and normally is heavily involved in several of the other key appointments as well, but particularly the CEO. Then, of course, the CEO day-to-day manages, directs most of the hiring. So we see a chain of command up to the CEO, okay? And then the CEO is supervised by the board. Now, historically, in the Japanese case, most of the members of the board came from inside the company. They were kind of promoted upwards. And sometimes they say they were kicked upstairs, is sometimes the old expression, that to kind of get them out of day-to-day management, you put them onto the board of directors, which only has a monthly meeting. And if you're on some committees, you might have some responsibility. So we tend to see that the retired shacho, in a way, steps aside and becomes the kaicho, so the chairman of the board, and then the new shacho, typically my CEO. So the chief executive officer is day-to-day involved in running the company. we do see in some circumstances, well, quite often, probably far too often, where you see someone is both CEO and chairman. That's not uncommon. It's very common in a very small business where it is the founder, Shah, who's created the company, because they are the shareholders, the bulk, the main shareholders, but they also want to run the company. So they're chairing the board. And that's why they have the title, because it was created as a company. They actually have to have a board structure with directors. So they make themselves the chairman of the board and also the top manager, the CEO of the day. When it's a larger company, having one person doing both is very problematic, because it effectively means that the chairman is supervising himself or herself. Okay. And we see that this was strikingly the pattern with Carlos Ghosn in Nissan, made even more complicated because at one point, the largest shareholder who had representation on the board was Renault, and simultaneously he was chairman and CEO of Renault as well. So he was kind of supervising himself as the head of a French company, which is the largest shareholder, supervising himself as both the chairman and CEO of Nissan. So is it any surprise that some misunderstandings could arise and questions of accountability could come about? And we'll look at later on in the Nissan case, because some of the changes they made there actually are to shift towards a textbook kind of model of what a better board structure looks like. Okay. So given that you might end up being sued, losing your house and whatnot as a director of a company, if the company does something wrong, individual directors want to protect themselves. And so there is a business out there. You can buy directors' liability insurance. And we'll come back to this notion again in several contexts. But a key Anglo-American legal concept is the notion of due diligence. You must be diligent. You must be sufficiently attentive to all of the issues that common sense suggests could impact on the value of the company and the company's impact in the world at large. Ignorance is no defense. For example, if a company doesn't have a COVID-19 plan and you have a huge cluster and lots of employees get sick and the company had not allowed people to work from home, they are in an awful legal position now. People would sue the company, and the directors could quite easily be found to have not shown due diligence, because you can't pretend you didn't know that corona was one of the primary issues and threats of the time, and you should deal with it. When it's more emergent risks, this is when it gets very, very, very difficult to figure out, and it really is case by case. In the Anglo-American law, it has the advantage that this notion, it's a very old notion, but it can be constantly updated to changing circumstances. And courts effectively look at the case and they try and extend the principles. So very often in the Anglo-American world, what happens is law catches up with the courts. The courts lead the law by creating precedents, and this key thing of precedents, kind of zenre. In the English legal tradition, a lower court is bound by the precedent of a higher court. So you have two cases with very, very similar conditions. And for example, the Supreme Court found in a certain way, made a judgment about liability, for example, that someone didn't do due diligence, for example, in relation to cybercrime, cyber terrorism. That everyone knows is an issue now. They say, okay, come on, didn't you read the newspapers as you had no plan? Right, okay, you didn't do your sufficient due diligence on this. You are liable. Effectively, you've been willfully or shamelessly neglectful. And so then junior courts with a similar case, if the lawyers can convince the judge that the circumstances were very similar to the case that was decided upon by a higher court, that precedent becomes binding. This also helps us to explain to some degree why there is so much focus on the Supreme Court in the United States, because judgments of the Supreme Court, they're not only kind of binding on governments in terms of, say, constitutional matters, but in so many respects, what they do is they actually lead regulation in so many ways. This has advantages and disadvantages. because of this Anglo-American context, lots of people who want to change the world think that the way to change the world is to become a lawyer. Um, so to win some famous cases, get some principles established, and then have them normalized through legislation. The problem with that, and we're seeing this in relation to various issues in the United States right now in the election too, is that you don't make the effort to kind of convince the people at large. That if you convince one or a bench of judges of your argument, you've kind of won the day, and then the law will kind of catch up with that, and you kind of hope that public opinion will catch up with that as well. Very often it doesn't. In fact, it actually simply divides public opinion and leads people to try and fight to interfere with the judicial system, as we've seen exactly with Supreme Court appointments is an ongoing issue in the United States right now. Whereas if you have to win the argument out, go out there and actually make the case, then you get much more acceptance of policy. Also, in many cases, law doesn't help. And we see, particularly for international issues, someone who wants to make the world a better place, they become a lawyer and they say, I want to do international law. But with the exception, with very limited exceptions, governments actually ignore ostensible international law. Under some circumstances, kind of yes, and we've got a few colleagues who are specialists in this. But when the issues are grey, and there are national security issues and whatnot, then no amount of indignant claims, but technically in international law, you're in breach of this, blah, blah, blah. Governments go, nah, okay, tell it to your mother. We don't care. Governments are entirely accountable to the domestic constituencies. For example, I'm quite familiar with the Arab-Israeli, which is not Arab-Israeli dispute anymore because many of the Arabs have now done peace deals with the Israelis, but the Israeli-Palestinian dispute, there's 1,000,001 lawyers involved in the issue, which have probably just made it worse. It actually comes down to politics and winning the argument and trust-building exercises, and law tends not to be well suited. But nonetheless, the broader observation about Anglo-American law that it can adapt to particular circumstances quite speedily, it has been a powerful competitive advantage in capitalism. And it's the reason why most international business, the contracts for trade, even between countries, between companies, neither of which have any background in an Anglo-American country, normally specify the jurisdiction for resolving a dispute as, say, London. Sometimes New York, but mostly London, because the law is considered to be very, very flexible in response to changing circumstances of technology, social values, a whole range of things. So we have to ask ourselves next, why actually would governments restrict the creation of companies? And when we talk about the politics of corporate governance, we'll see some particularly cynical reasons to favor certain companies. I shot a video, and I've got lots of videos to edit and upload, and I'll be doing that over the weekend. I've shot a video which I talk very specifically about the South Seas Island Company, and a very specific case where, for very self-interested reasons, they encourage the government through a law making it difficult to actually create other companies because they wanted to attract all the investors to their company. So quite cynical. By the way, my dilemma with that video is I shot it outside. It was a bit of a windy place, and so the sound is actually not so great. But I think I'll put it up anyway after I've tried to edit out some of the sound problems. Anyway, with the restrictions of companies, one of the main reasons is because of this notion of the veil of incorporation that covers your face, okay? An asset could be under the control of a legal entity. When an asset's under the control of a legal entity rather than an individual, who controls it? Who is behind the scenes controlling this? And we can do this in many ways. Lots of shelf companies or a complex web of companies to hide transactions, to hide the beneficial ownership is the normal legal description. And this is a huge issue with the regulation of foreign investment, for example. Governments go to great lengths to try and make sure that certain strategic assets don't fall under the control of less friendly parties out there in the world. And of course, those who, for strategic reasons, want to take control of an asset that they might be able to use for other than simply financial ends, you know, like controlling a port, controlling communication system, buying a building next to the Ministry of Defense so you can look through the window, or bug their conversations or whatever. So there are foreign investment screening mechanisms and rules in pretty much every country has them. Some are very liberal, some are very illiberal. All of them have the problem of finding out actually who stands behind this company. You know, ABC Investments Limited. Is it, for example, a Chinese enterprise which is actually owned by the People's Liberation Army, the PLA, for example? That's an issue that's come up several times in my country, in Australia, and it gets very, very politically contentious. Now, the veil of incorporation had certain advantages too, and I've already mentioned it briefly in the previous class, but allowed people who might face prejudice to finance business ventures, and this led to higher rates of economic growth. So religious minorities, for example, or just simply elites who didn't want to be seen to be in business. I mentioned about in the English case, the prejudice against being in trade. This is a similar kind of factor. So that there was a lot of money with aristocratic interests that could be directed to supporting new entrepreneurship. But they didn't really want everyone to know that they were involved in business themselves. At the same time, you can have crime gangs, enemies of the state, a whole range of people, people who have a bad record of ripping other people off, hiding behind a company name to control an asset. This is a big issue, actually, because when people do bad in business, very often they are banned from directorship, from controlling a company for a certain period of time. But they want to do business, so they try and hide their control through another new company that they have created. So in legal terms and regulatory terms, we often talk about lifting the veil of incorporation. So open share registers, disclosure provisions for significant shareholders. And you get a lot of hints from this. If you are doing shukatsu, for example, you absolutely must. To my mind, if you're applying to public or looking to apply to companies, publicly listed companies, get the Shikiho, the big books of all the listed companies on the stock market. You can find them in the Wasa Library if you do happen to be on campus. But they're quite cheap anyway, even the first and second sections, the two of them together, about 6,000 yen or something. Or you can do Tachiyomi if you want to in the bookshop. They will list the major shareholders. And that can actually give you a considerable degree of insight. You know, if you look at a company and see who are the main shareholders, who are the members of the board of directors, for example, you can find out if it's what Japanese call one man or maybe one woman company. That is, although it's a publicly listed company, is very much dominated, for example, by the founding family, or very much dominated by a large shareholder. So you get some sense of intuitively how the company might be run, its strategic direction, by looking at who actually runs it. So these disclosures are quite significant. Where it gets a little bit complicated from a governance perspective is that you get lots of fragmented holdings, typically under 5%. And there are regulatory reasons for that we'll come back to, where you'll get something nominees or something investments holding 3.4%, 4% or whatever. These tend to be investment funds, which are a very significant part of finance these days, institutional investors. And we'll talk about this in another class. And so control issues often come down to the analysts that work for these institutional investors, getting a picture of how well the company is run. And if widespread dissatisfaction takes hold, these institutional investors may collectively at a shareholders meeting vote, for example, to kick people off the board, and in turn also to say indirectly then replace the CEO. And when we do see control events, people trying to get control of the company, and we'll talk about this next live session. Of course, if you just jump into the market and declare, I'm going to take control of this company, I'm looking to get, say, 50% of all the shares, what happens is the share price immediately shoots up, okay? because there's always a premium for control. And on average, it's about 40% to the closing price before a bid is launched. So if you happen to have shares, which in a company which gets targeted for a takeover bid, and particularly if there are competing bidders, you can make a lot of money very quickly. It's very, very nice. It's wonderful. It's what everyone kind of hopes for, actually, when you invest in a company and hope that someone tries to take it over and you can make a big capital gain, the share price goes up. So of course, if you're trying to take over the company, you'd like to quietly build your stake and kind of sneak up on them, okay? So you can get it cheaper. And one way to do this, of course, is to use lots of different shelf companies, ABC Investments, XYZ Investments, buying a few shares here and there, buying them on market, not drawing attention to yourself, and then slowly building a stake in it. Now, for various reasons, there's always debates about this. There are laws which say that once you get above a certain threshold, you have to report all changes in your holdings. So in a lot of countries, it's about once you're above 5%, you have to publicly declare to the market that you've increased your takeover, you increased your shares. Some countries have rules where actually if you go over 20%, you actually have to launch a full takeover bid for the company. Or declare that you won't. It works in various ways, and we'll see logics for that later on. At this point, we're interested in the fact that if you allow people to freely create companies, hide behind them under the veil of incorporation, then a lot of unfairness can result. People can avoid their responsibility, avoid liability. People can get things cheaper than they would in a free market where everybody knew exactly what was happening, the market for control. So they're some of the reasons why companies are restricted. I'll do a video on demand very specifically about some other cases, more political cases. Okay, so I want to go next to the firm and finance. Okay, and before we do that, let me just throw a really simple little poll up. Okay, so. And this is about whether you'd like to work in finance. So the change this to make it multi-answers. It's very technical, but I'm curious. Finance is a very broad category of employment. I have noticed in the past that plenty of SIL students, for example, seem to have an interest in kind of Gaishke. Some people would like to go to Morgan Stanley or Goldman Sachs, GS or something, and really keen to do that regardless of the role. Actually, one of my zemis, two of my zemis, gone to operations in Goldman Sachs fairly recently, which moved, both of them had to move to Singapore to do that because Goldman Sachs has offshored most of their operations, except for a pivot small office here in Tokyo. Japanese banks Altair used to be very desirable employers for some Waseda graduates. They're considered very stable. This notion that the money is the blood in the body of capitalism, and particularly when finance was rationed, the banks were in a very powerful position, and so a lot of people thought a career in a bank was both a stable job, a well-paid job, a respectable job, and one that was very unlikely to disappear, that the banks in particular would be helped by the Japanese government if they ever got in trouble. And indeed, that's exactly what happened at the end of the bubble economy, that we see the banks got massive assistance, and they survived as a result, except for a few small banks. But they're struggling these days, and deflation has some wonderful advantages if you want to go out and buy a cheap house in the country and whatnot. It actually makes regular retail banking, a really difficult business to be in because the margins are so incredibly low. And now we're facing so many other challenges, such as I've listed here, fintech, for example. Okay. I'll leave the poll going there. Okay, we've got 50. We've still got how many people? 20% of people still haven't voted, which has me kind of curious. So, by the way, while we're doing this, can everyone just in chat to keep a record of attendance, because the screenshotting gets a bit messy. can you just put 4 and hit return in chat? And I export the data file, and this is the most reliable way to do it. Okay, and it also timestamps it. So, okay, right. So I'll give you just a couple more minutes with that poll, because I'd like to I don't want it to drag on. Okay, anyone else still to do it? Okay, I've only got 86% response. That suggests to me that some people have got Zoom open and are not paying much attention. Okay, well, I'm going to find out who they are, aren't they? Because I'm taking attendance right now. That's okay. So hurry up and do it. Okay. Once I hit 90%, I'll end the poll. 5, 4, 3, 2, 1. I'll end the poll and I will share the results straight away. And it's quite interesting, actually. I would have said 10 years ago, it would have been higher, that actually more people expressed an interest in working in finance in some form. I think particularly after the global financial crisis and whatnot, a lot of people has realized that yeah, you can win a lottery. You can luck into one of those really big bonus earning jobs, but even the headline figures about the big bonuses, that actually what individuals get is actually not so high. It's still better paid than many places, but also that many of these companies are quite ruthless in terms of downsizing, offshoring, and whatnot, so that it's not necessarily the path to riches that a lot of people assume. And a lot of people also end up in operations because their English is good, which can be extraordinarily tedious, mind-numbingly tedious. But if you're only thinking about making art and you just want to go to work and do your job and come home again, that can be okay. The higher paid jobs, and particularly the things like the analyst roles and whatnot, they are hard to get, and you have to work extraordinarily hard. I'm just screen saving the poll results. Excuse me a moment. Okay, but just to look through the results here. Okay, 34% interested in finance. Okay, in a foreign finance firm, any job. Yep. Yeah, I really do urge caution, actually, for people who just want to get into Goldman Sachs or whatever. Those big Geishke will always tell stories about, yeah, it's possible to come into operations and then switch to what you really want to do. It doesn't happen as often as people say. The companies will always trot out some people who have made that transition for that sell. But be wary about those stories. For the very simple reason that there are obviously a lot of very bright people in those organizations. The competition is intense, and these just the way it works. I don't see too many instances of people who manage to get out of, for example, operations roles into the kinds of dream roles that people want to have. Okay, whether it's traders, analysts, or whatever. Okay, banks. Okay, interestingly, the banks have pretty low popularity. よく地方に飛ばされちゃうしね. So it's fine if you get to go to your home region if you're from out of Tokyo, but can be really challenging for personal relationships and whatnot. Okay. People, if you can catch an attractive rich trader, rightio. Yep, that's still a bit of the dream. Interestingly, lots of research, behavioral research now in finance suggests that although it's not yet the case, traders should, in general, women should be employed as traders because on average, they are calmer. Men tend to have too much testosterone, and so they tend to swing between wild optimism and wild pessimism. So they kind of buy, sell, far too volatile, which is quite funny because for hundreds and hundreds of years, men always said that women were too emotional. And shouldn't be allowed near things like military, government, or money. And then very sophisticated analysis of the trading strategies and positions of traders in New York, for example, and financial institutions have shown that actually women are actually, on average, much calmer, much more rational traders. So guys, we really are the emotional ones. By the way, given this beautiful weather, maybe many of you know this, that expression, aki no sora to ono gokoro. So, you know, autumnal skies change like a woman's heart. One of the most interesting things I saw ever on Japanese TV was a Japanese historian explaining very carefully that the original expression was actually otoko gokoro, or otoko no kokoro, that actually men change their emotional attachments to people. Just like autumn skies, somewhere along the line, some sexist writer flipped it to say it about women instead. So the original version seems to have been the right thing, at least when it comes to working in finance. Okay, we'll stop that share. Okay, so now let's dive into some slides about finance. And I am really conscious that it is a bit of a strange thing. So you're just looking at talking slides. But still, at least it anchors us in some text and some information. All the research shows that listening is pretty good for understanding. Reading is pretty good for understanding. And some tutor humper mix of the two is actually kind of bad. Okay, message just came up in chat. Okay, right. Get rid of that. Okay, firm and finance. Okay, so briefly, let's remind ourselves of the corporation's advantages, and particularly from a finance perspective. And we'll talk more and more about this when we talk about the rise of the mass corporation in the United States, for example, but where you should be with the textbook now. Getting up to the end of chapter 3 by quiz time next week is very important. That'll start to become obvious in the text and will become a key theme subsequently. So the corporation is best suited to large-scale business enterprise. There are some limited exceptions, such as insurance and whatnot, where you can have other forms that work, but we will come back to it. But the critical thing is the corporation, we're talking in broader terms here. So we're not just talking about the for-profit publicly listed company, but largely we are. And what I mentioned, saying the large collective-based health fund, for example, this second point still applies. The separation of the financing function and the managerial function. Okay, so managing the asset and financing it. This is to us pretty obvious these days. Historically, it wasn't obvious. Okay, but why we need to really emphasize this is that it effectively allows specialization according to your advantage, whether you've got money, whether you've got talent, whether you've got passion for doing business, whether you'd rather do something else. And the third part of the story here is the role of the universities in training up a managerial specialist elite to run these entities and separating that from financing. Okay, so in short, if you've got money, the holders of capital, they can invest in companies, in businesses, without needing the time or skills to manage the enterprise. They had 2 SILS students here who were sisters who inherited a very well-known company, a very large company, very valuable company. I won't go into all the details. Neither of them really had any interest in business, okay? The older sister, she really wanted to run an art gallery. And the family business was a very different kind of business. So effectively it was left to professional managers, and some of the earning from the business as shareholders accrued to them, and they could do the personal projects they wanted to do. Now, the advantage of this eternal entity of the company that doesn't die is that it provides a decent foundation for large-scale fundraising, for doing technically complex enterprises, creating scale economies and innovation, okay? So we get to what economists call technically efficient scale. You can, the business can become absolutely giant precisely because you have separated the management from the ownership of the thing. There are just not enough people with enough money around to fund a really large scale enterprise that they themselves would control. So you really need to be able to put lots of people's money together, and to also ideally have it run by specialist managers. So it allows individuals with a talent for management to take roles without having to provide any money. So you can be really poor, but really smart, and you can end up being the CEO of one of the big corporations of the world, which has a larger turnover than many countries, for example. So this is, when you think about it, it's obvious, but in this revelatory kind of way, that in only a century and a half, if we got to the point where the issues of who provides the money, the finance, who manages the business, are actually completely separate. And it allows each person to do what they do best. Okay, so we have achieved remarkable efficiencies with this structure. Let's remind ourselves of what financial markets do. Let me have a drink here. Really briefly, obviously they provide payments mechanisms. Much of the revolution we're seeing now with fintech is actually in this thing, the payments mechanisms. Everyone's competing now. All these financial institutions, they've got these rival non-toka-pay. So if anyone starts a business called PokerPay, I'm happy to do that for a mild commission of about 0.5%, okay, to fund my retirement. But I don't think anyone would get excited by PokerPay, okay. We do see that so many institutions recognize that if you can make yourself part of the financial architecture, you can pick up a margin on absolutely everything. Credit cards, they're picking up a 3% margin or something on every purchase. So it's incredibly lucrative for Visa and whatnot. So all these cashless payments are moving this way. So PayPay and a million different businesses are trying to do it. And it's going to be a real shakeout. Plus, you then get a whole bunch of people creating these cryptocurrencies based like Bitcoin, trying to get to become part of the currency system for the payment system. And we will have a bit of a conversation about that later in the semester. Another key role of financial institutions is just to intermediate between the capital rich and the capital needy, people who need money and people who have money. Simply, banks, for example, when they do this, they what we call interpose or put, they're nice fancy word to say, put their balance sheets between the lenders and the borrowers. So they are actually taking on risk, okay? You put money in the bank, the bank promises to give that money back to you with an interest payment, although in our current environment, it's absolutely ludicrous, despite all the money that flows through my Mitsubishi UFJ account each year, all of my pay and bonuses and everything. I think they paid me 3 yen in interest last year. But they don't charge me for my bank account, which is a lot better than both my Australian banks and one bank account I've got that used to be Citibank in Japan became Prestia, and they charged me 1,500 yen a month or something for my the privilege of having an account. The only reason why I still keep paying is I haven't had time to go and get rid of it. Okay, kind of hold up and take a margin, okay, off you. There's so much business is based like that. But as intermediation means that if you are going to take deposits and guarantee to return them and pay an interest rate, and then you're going to give loans, the people have to pay a interest rate onto you, and you make your profit by standing in between the two. What you have to be really good at is risk assessment. And we'll talk further about this. But there are really complex sets of issues in terms of identifying the good and bad behaviors of people, markers of good and bad behavior around moral hazard and adverse selection. There's some things that those of you who've taken Introduction to Business have heard of, and I will go back to later on. So facilitation is another thing. Intermediation, facilitation, slightly different. Facilitation is just introducing people to each other, stock markets and brokers, any kind of platform, for example, which allows buyers and sellers to meet, but is not doing it on their own account. So they're not intermediating. And we see so much of this in life. Aggregating and disaggregating savings. We tend to overlook this, but this is a very significant function of financial markets. They gather lots of small deposits together, lend it as bigger loans. So otoshidama, you put it in the bank, they gather lots of kids otoshidama, and then they lend it to someone to buy a house, for example, okay? Similarly, large funds can be disaggregated into consumer credit. So Apple makes squillions. They money goes into financial markets, into financial institutions, into banks, for example. And then that money can be, those big lumps of money, huge lumps of money, can be chopped up into smaller amounts and extended as consumer credit. Credit cards do this, for example, all of these things. And the most important and most challenging thing really for anybody who's in this intermediation kind of role is to reconcile intertemporal differences. So that's just timing differences. Very simply put, if you put your money in the bank, you want to be able to get it back at your convenience. Even if it's a term deposit like Tiki Yorkin, most people, they never go beyond a year with the rollover instructions. If, on the other hand, you want to buy an apartment, to buy a house, typically in Japan, people take a 30-year loan. So reconciling those things, the banks have lots of money that on deposit, but they have to hand that back very often what we call on call or at relatively short notice, short time frames. But on the other hand, the loans that they've given are being paid back very slowly over a long period of time. So reconciling those become very temporal differences. Those timing differences are a huge challenge. And that's how a lot of banks, and indeed a lot of even good companies, get themselves in trouble. It's quite possible for a basically successful, profitable business to fail because of timing differences, the classic cash flow problem that all of you, I think, know. Particularly when you start to work, you'll discover this in the beginning. All of your costs are up front and there is a delay in getting your income. So once you start work, once you graduate and start working, make sure you've got some savings to get yourself set up until you actually earn your first pay, and particularly your first bonus, which will be only a small bonus because you'll typically start from, say, the 1st of April. And of course, lots of people, they have a Sotsugo Ryoko, not maybe in Corona days, and they tend to blow the credit card. And so many people start off their working life by having a cash flow crisis, okay? So having to go to the bank of mum and dad to make these things work. Now, corporations have certain advantages in finance. So another drink. Big one is it's a major instrument for investment diversification, okay? And it does this in two ways. It pools risks is a critical thing. So we see it can reduce the risk for individual investors even while leaving overall risk unchanged. So the risk at any given time of businesses failing because of exogenous external shocks is unchanged, but that risk is collectively easier to bear if it can be placed in the hands of people who can most bear it, or if it can be divided up and packaged in a way so that no individual carries a disproportionate amount of the risk and doesn't want to do so. So how does this work? Okay, well, first of all, if you've got lots of companies and their shares are publicly traded, investors can have small exposures in multiple businesses. Let's say you've got $100,000 now to invest. Just a lot of money. 100, that's a lot of money, yeah. $100,000. If you invested it all in one company and that company goes badly, then you lose a lot of money. If, on the other hand, you spread it across, say, 10 companies, then you've got what we call diversification. So you don't put all your eggs in one basket. Alternatively, you could buy only shares in one company and still have a degree of diversification. Because if it's a very big company that does a wide range of businesses, then it itself has diversified. So it has a risk hedge, okay? So we think in terms of a shipping company with many ships. A shipping company with only a couple of ships and one of them sinks is in a very, very bad way. Shipping company with 500 ships and a couple of them sink, okay, well, you get that. The old cynical expression in finance, you get that on the big jobs, okay? So things go wrong, it's like, meh, okay, it's just part of a portfolio approach. By the way, I always encourage people to have a portfolio approach to shopping. Some things you buy will turn out to be the best thing you ever bought, like the most comfortable shoes you ever bought or whatever. Some things you'll buy, you'll hardly ever wear because you got it wrong or they're uncomfortable or whatever. Cut your losses, give away those things nice and early or sell them on Mercari or something. Move on, cut your losses, and be grateful for the ones that work out. So have a portfolio approach. Some things work out better than others, just like friendships too. Get some dud friends, you get some fantastic friends, and it's not You're not quite sure up front which ones are going to be which. Okay. The second one, though, it is, you can think in theory, a company that does everything would be perfectly diversified. You know, they sell sunscreen for the sunny days, which I should have had more on. You can see my face is all burnt on Sunday. Obviously, it was in Tokyo. So, in fact, the first time I got out of Tokyo. When you see the videos, you'll see why I got sunburned. In fact, I even made a video about risk management and sunburn, but trying to explain the metrics of risk assessment. So I thought, okay, SPF factors make sense. Anyway, imagine we've got a business that does everything. They sell sunburn cream, they sell umbrellas and everything else besides, okay? You're not perfectly diversified because it's still under the control of one management. So although they may be in every business, but they may screw up every business, okay? So it's not enough to put all your money in one diversified basket, because you also have exposure to manager risk, okay? And compliance risks, so many different things. And we put in currency and whatnot. So a significant role for financial markets is actually risk hedging, diversification to minimize risk. And you see, if everybody, the same amount of risk out there in society, that if we slice and dice it and put it into packages where for each individual, it's risk hedging, okay, then collectively that risk is a lot easier to bear. If every person was only allowed to invest in one kind of business, everyone would be constantly afraid that they were going to suffer financial disaster. They would also spend less money. They would save money rather than spend it. And that would be damaging for the economy as a whole. By the way, that also gives us a little bit of a hint we're going to come back to. One of the problems in Japan with low rates of job changing traditionally with lifetime employment, that people felt very high level of exposure to one company, especially when even the Taishokin, Ninkin, so all of your retirement benefits, health benefits, and everything are tied to one company. That can and should make you rather nervous. So many of you know this, and this is just a kind of a summary of actually what I've talked about in Introduction to Business, but just a quick reminder. Debt finance is what we call non-contingent. That is, the return to the lender is predetermined, and it's not contingent on the performance of the borrower, okay? So the firm doesn't share risk with financiers, but the management still presents a risk. The lenders face a default risk, okay, if the loan is not paid back. And so banking is a risky business, is a critical thing, and hence risk assessment is important, as I've already spoken about. Equity, of course, is issuing shares in a company to investors, and it is completely contingent. It depends on the performance of the company, and therefore it makes the return to the investor dependent on the performance of the enterprise. And this is an important word. I should have bolded it. The shareholder is what we call a residual claimant. They get shares in the residual, the profit that is left over, or they get a share in the loss, okay? And the quid pro quo of that, in return for that, they get a right to voice in the governance of the firm. Bankers don't get to interfere in the management of a company day to day while the company is paying interest on the loan, while it's holding up its side of the deal. And even when it's not, bankers really only get a voice in the company when the company is in the process of going bankrupt, when it goes into administration, for example. Then creditors get an input. So bankers have to get it right before they lend the money. Shareholders have a ready exit option if they convince someone else to buy the shares, and they also have a right to voice. So very different dynamics. Raising equity. We'll talk later on about startups and whatnot. That gets rather different. But once a company is actually up and running and doing okay, it can issue a prospectus. It can offer shares through the share market. And this is what we call an initial public offering. This is where many entrepreneurs get the reward for their risk, which is the key theme for this week, that they've created this business. They've got it to a healthy state. They do what's called a float. They put the shares on the market for the first time at a certain offer price. People often expect them to rise, and so there's strong initial demand for the IPO, strong demand for the IPO. And this is when this thing that you've created suddenly has tangible financial value because the total number of shares in the market, and you see they're trading at a certain price, you can work out the market capitalization. So then the founders of a business may sell some of the shares to get some cash, to buy the goodies, the rewards, the bling, the sports car, the big house on the harbor, all those kind of things that may be motivated to try and create the business in the first place. An ongoing business can also go back to the market and raise equity. And they often do this when they're in trouble, or if they have a great new business opportunity, but that they need some more capital to take advantage of it. So in the best of times and the worst of times, there's often additional capital raising. And this is done through issuing rights to new shares to existing shareholders, typically, or selling them to third parties. Now, existing shareholders don't like that because your share of the company, say company's worth $1 million and you got 10% of the shares, if the company issues new shares, and it's what's called share dilution, and we'll talk about this. ANA, for example, has done a capital raising to protect itself in these very, very difficult times because they've just declared a horrendous loss, unsurprisingly. So private placement and public subscriptions are different ways of doing this. The private placement, they normally do this through financial institutions. With their sales teams, will get on to institutional investors and try and sell the shares privately in advance. There are advantages and disadvantages of both. The private placement is lower cost, but often raised in terms of operationally, but often raises less money for the very simple reason that you're selling to very savvy institutional investors. A public subscription, if it's very well marketed, if you can get buzz around it, if it's a company that people are enthusiastic about, you're selling it to mom and dad investors and retail investors, it's often called, and they'll often pay a higher premium in an interesting way. And so there's a lot of people dissatisfied out there from past public subscriptions, whether it was NTT in the Japanese case or in Sony, Telstra in the Australian case, I don't know, well, the telecommunications company. This is often a case when governments actually were privatizing businesses. And some of the worst offenders in terms of public subscriptions, of taking money off investors, small investors, and disappointing them, has actually been governments selling publicly owned assets. So efficient stock markets, in essence, what do they provide? They provide finance for innovation and new market entrants, okay? They also provide an incentive to entrepreneurship because the founder can exit a successful investment through the public listing, okay? They can sell down the owner's stake in the company. So it provides an effective means of exit. And because there's an effective means of exit, it provides an incentive to enter the business in the first place. Now, you don't have to sell it through the stock market. You can create a business and then you can sell it to another business. And a lot of what we've seen in terms of IT startups have been much more geared towards this, creating an interesting business that then you hope Google will buy off you, for example. That's kind of the ideal type. That some of the major players will take an interest in what you do and will buy it off you very cheaply. And sometimes you get to keep your job even while actually getting rich at the same time. So effectively, when we think about the company in relation to finance, their great strength is their specialization in risk. They're unique organizations because they make no restrictions on who can own their residual claims. This makes it possible for customers, managers, labor, and suppliers to avoid bearing any of the corporate residual risk. That's the message from Michael Jensen there. So in short, it allows specialization in risk bearing, realizing very considerable efficiencies. Now, there is a basic question of why would companies go public? We will have a look at statistics across different areas, different regions and nations, and we'll find that there's actually very significant variation of this. In America, it's much more likely for companies to list on the public, on the stock market, to become public. When we say public, we mean publicly traded. Okay, so 株式市場で売買されるような上場されて売買できるように株。Okay, so why do they go public? Well, wider access to capital for expansion. That's a very significant thing, of course. And that means at the same time, greater risk sharing. It reduces debt servicing costs. If you're borrowing your money from banks, then you are going to have in the short term the problem that you have to just keep paying interest all the time. And you have to pay interest in the really bad times. So there are many businesses that are fundamentally good businesses that are now failing for the very simple reason that their cash flow has gone to zero because of Corona, with a lockdown, particularly in places where whole sectors have been closed. The large bulk of restaurants and even retail spaces in Melbourne, in Victoria and Australia are currently shut. There are lots of businesses that just simply do not have the money to pay their bankers the loans, nor to pay their landlords rent. I had a chat in the street just after I got off the shoe den the night before last with kind of a I'll say he's a mate of mine. I've got to know him quite well. Osman, who runs a kebab shop, and his Japanese girlfriend. And they're having a hell of a time of it. Great guys, great food. But of course, customers' numbers have dropped dramatically. And of course, the landlord absolutely refuses to cut the rent. And so it's kind of day pinch. Taxi drivers have told me a similar thing, that many of the taxi drivers, they're driving leased cars and the leasing companies absolutely refuse to drop the leasing charges. So they're caught between the collapse in customers because of the crisis and very high fixed costs of paying their bankers, paying leasing fees, paying rent, for example. So these fixed costs in a crisis are disastrous. Good businesses can get crushed in these circumstances. On the other hand, if you've raised your capital through issuing shares, you're effectively sharing the pain and you're also sharing the upside. However, we will see there's an interesting twist on this, that longer term, your cost of capital is higher if you're financing through equity, but that's because of the volatility. So if you're not going to you're going to get paid every month, ultimately you want a higher risk, you want a higher return to compensate you for the volatility. So many businesses find that they can get loans, or effectively something equivalent to a loan, by issuing bonds, Seiken, corporate paper, that have a interest rate which is lower than what they have to, the firm has to be kind of paying in dividends to get shareholders to hold the shares. So it becomes very tempting to actually use debt, but then you can get crushed if there is a sudden impact on your cash flow. Okay, this is all how so many people in finance get themselves in trouble too. And I've seen several students get themselves in a terrible state. They've gone to work for Gaishiki UK, mecha choshi not there. They go and buy the expensive car on a loan. They go and get a very nice apartment somewhere, very high rents, buy lots of bling, and the company pulls out of Japan, and then legally can sack them, even if they're good employees, okay, because they're downsizing. And so suddenly they find they've got all these fixed costs, and they're caught out. So ironically, some of the people who have the greatest problems actually in terms of cash flow are some of the highest earners, because their lifestyle, their fixed costs rise more quickly than their incomes do. And that's the danger of falling into the relationship with the person who wants to catch the very attractive bond trader. They want to catch you because they want to live in a very nice suburb, send a kid to fancy schools, drive fancy German cars, have very expensive international holidays. And if the bonus doesn't come in as you expect, then you suddenly have a crisis. So those friends of mine in finance who are the great survivors all actually have a really striking thing in common. All of them are actually very modest. If you met them, you wouldn't even think they're a finance person. The guy I know in finance who makes the most money normally wears like Uniqlo trainer to work. Okay, people think he's like the Soji Oji-san, and he's one of the best paid people in the organization. He knows to stay modest because he's seen an incredible number of people suddenly get fired. And after the GFC, I said to him, I guess a lot of people are getting fired in your firm. And he goes, yep. And I said to him, do the ones who get fired see it coming? When they're told, sorry, I've got to let you go. they say, yeah, I thought so. And he said, no, the ones who get fired never see it coming. Okay. The ones who don't get fired are the ones who live in fear of getting fired. Actually, there's a really, really powerful lesson. Like, 調子に乗ってるやつがいつクビにされてもおかしくないで。でも調子に乗ってるからこそ、もうすごいもうすでに借金してるとか、もうめちゃ豪華なライフスタイルしてて、大ピンチになる。Okay. So look for the modest finance person, not the person acting like the finance person, and you're probably onto a much better investment. Because there is one very clear thing in finance: fake it till you make it doesn't last very long, because you pretty quickly get caught out at the first time there is financial difficulties. Okay, in terms of going public, bringing it back to this, what do we see? The liquidity is a huge advantage, and the ability to go back to the share market and raise more capital if you need it. And this often feels like a shakedown for existing shareholders. Companies that get themselves in a difficult position, overexpansion, for example, and then they get hit by, say, Corona, they need to raise more capital to stay alive, and investors have already taken a hit, actually have to buy more shares for the very simple reason that the company needs the money to stay alive. There will be dilution, okay? You will be sharing your share of a diminished company will be even smaller still. And people also think, well, okay, I bought the shares at 1,000 yen, they're now 300 yen, and they're offering me some more at 250 yen. Well, okay, I'll buy some more, and I'll add the law of averaging. So on average, I won't have lost money. So there's actually a bit of a psychological trick that kicks in. And we will talk more about the psychology of this in general. Okay. One of the really important things is that publicly traded shares become a currency in their own right. And remember, we're in an era where people are looking to make new currencies. You know, Bitcoin is a new currency. All of this crypto, and most of it's just utter garbage. This idea that we have new forms of currency. Well, we actually have a lot of other currencies too. We have frequent flyer points, for example, are some of the most valuable currencies around, not least because tax office doesn't treat them as currency. I would much rather, when I go to KO, be paid, well, not now because of Corona, I would much rather have KO would actually give me large numbers of frequent flyer points rather than cash. Because if I'm given cash, then I have to pay a large number to the government. If they give me frequent flyer points, I don't. Okay. So currencies that don't count as cash for tax purposes have value. One of the most valuable ones of all, from a corporate perspective, is actually publicly traded shares in their own company, because they can actually do a share swap to acquire other companies, to do a merger without all the problems of having to go to the banks, for example, to do this. So by boosting the value of your shares allows you to do M&A in interesting ways. We have to remember, though, that public listings are very, very costly. There's a high status associated with public listing, but it also entails very high costs in terms of compliance and investor relations. And I will show you some examples of this. Just the putting a prospectus together. You're required to send it to every single shareholder. I still have some shares in Australian companies, so I get a lot of international mail, big, thick books. These days, more of it comes digitally. What we see is often the small market firms, it's not as good for them to be publicly listed for the very simple reason that they're often too small, that the big investors don't want to take stakes in them because effectively they become a very significant price maker. They can't exit very easily. This is a key problem. And limited analysis, a limited return on the analysis, low liquidity, a whole bunch of reasons why it's a problem. So we do see companies being bought through a takeover bid and being delisted. That sometimes makes sense. Now, one of the things we're going to repeatedly talk about is principal agent problems, and the in how the interests of different parties are not aligned. And when they're not aligned, this leads to a range of problems. And particularly the basic structure of the firm with its shareholders, and that so many people work for the firm as are employees and involved in management, and they have certain interests in the firm staying healthy that may diverge from shareholders. That seems a little bit unusual. Okay, why would their interests diverge? Well, the reason is pretty straightforward. Investors can have small stakes in a wide portfolio of firms. They invest in 20 different businesses, for example. And they might prefer that the firms just return any spare money back to shareholders. So if the company makes a lot of profit, they want dividends, they want share buybacks. That's where the company buys the shares off the shareholders for a bit of a premium, or a dividend. Say haito, ne? So keep it simple with haito. We'll talk about that with dividends. So typically what happens is when we see these foreign investment funds buying shares in Japanese companies, the first thing they demand is that the haitoritsu, the dividend rate, be increased. They say, we know you guys have got lots of cash. You're hiding the cash. You're sitting on the cash. Give some of the cash back to the shareholders. The management say, hey, you only just became a shareholder just because you know we've got cash. And I'm like, yeah, but yeah, that's how capitalism works. Okay. So anyway, the investors are thinking, if the company gives us money back, we can put that money into other investments, into other industries, financial instruments, better than the firm can. So, if I own a share in Bulldog Sauce, for example, I don't want Bulldog Sauce suddenly diversifying into online learning systems, Bulldog Education. You guys don't know how to do that, okay? That company over there knows how to do that. I would much rather you give me some of the profits back and then I buy shares in that company that knows how to do it better, okay? So the investors become a discipline for firms sticking to what they're good at, okay? Demanding that they become strategically focused. But the firm managers may much prefer to keep money within the firm. First of all, if you've got cash, you can avoid making difficult decisions. If there's lots of cash lying around, you don't have to fire people in a short-term downturn. One of the really interesting things is that many large Japanese companies are actually very profitable here, sitting on a lot of cash. And that's one reason why a lot of people aren't feeling the impacts of corona in the same way that they are in many Western countries. Western countries are more tightly run. Michael Jensen very famously says, debt is discipline. If you've got little cash, lots of debt, highly leveraged, you're very, very sensitive to your cost structure. So the management is very, very disciplined. So the firm managers, of course, if they've got lots of, we say hollow logs, money, stuck in tree, hollow logs, okay, then they can avoid difficult decisions. One of the ways that Japanese companies have done this in the past was to hold assets that they could easily sell relatively. Land, shares in other group companies and whatnot. If they got themselves in trouble, they could sell them down. Also, another thing we shouldn't underestimate the significance of. Top managers, to boost their own careers, like to expand into new businesses or like to do M&A. If you've got your LinkedIn profile and you can show, took this company from this amount of turnover to this amount of turnover by diversifying into 2 new sectors, developed a whole new business, it helps to sell yourself to a future employer, or simply just makes your job more interesting. That you get sick of doing the same thing all the time, so you want to do a new project, okay? Whereas the owners might say, stop wasting money on stupid ideas and concentrate on what you're doing best and make more money and give that back to shareholders. So there is a fundamental divide between the management and the shareholders on this. And simply put, in terms of diversification we talked about, a diversified portfolio investor does not need each firm to be diversified. They much prefer, actually, that firms are narrowly focused on one thing. And what we see is that companies that are narrowly focused actually have a higher share price for the very simple reason that institutional investors are much more interested in them. So there is a huge divide in interest between shareholder interests and managers' interests. And in a way, the managers and the employees' interests tend to be closer on this than the shareholders. And that's one of the things we'll come back to, that employees, of course, benefit when there's cash lying around in the company in the bad times, and the managers can avoid those really difficult conversations about firing people. And I'll just say in what I've noticed in universities, I noticed in Waseda, for example, you may have seen this, that I really do think that some of the Sennin Jimshokin get a little bit bored being in the kind of the education running Waseda kind of thing. And Waseda has been very tempted to do lots of kind of side things. and diversifying into even holding a joint venture in a travel company for, related to study abroad and various things. Well, actually, they got some really good people they headhunted from another travel agency. So in a way, we brought some very savvy people in. There were benefits. But I think that there is a danger of losing sight of what the core business is and just kind of focusing on that. And companies often get very short term. Also, they get too much into brand extension. They want to push their brand out and out and out into so many different domains, and it may be profitable in the short term, but the longer term, it's kind of damaging both to the strategic focus of the company and to their brand. And that's where the shareholders can impose a very strong discipline upon them. Okay, I'll leave it there. I underestimated how much time it was going to take to catch up on the Chapter 5 stuff, but that was really, really important about the board of directors and everything, leading to the conversation we're having next week. As you'll see, those of you who looked at the lecture notes, I've got 7, the firm and liability there, and I flagged that a big lump of that would be carrying over to next week. Well, obviously, all of it is going to carry over. And finally, the other thing I haven't forgotten about is, and I'll just write it in here, the firm in culture. So what I really want everyone to do, but I'm not going to do it through chat here now, I'll actually set up a little forum on Moodle. So please share any interesting suggestions you've got in terms of dramas, movies, documentaries, parodies, anything whatsoever that relates to kind of corporate life, okay? It can be anything from, I don't know if anyone ever saw the NHK, they did this really edgy, crazy kind of comedy skits very late at night where hardly anyone watched them, I think, so they didn't want the management to see, called Sexy Butcher, which was bizarre but super interesting. It's probably on YouTube. If you Google NHK Sexy Butcher, and you'll kind of find it. So I really want us to pull a whole bunch of interesting examples together. And one I'm going to put now, if anyone has the Prime subscription, and you do if you Amazon Prime, if you're just getting things delivered regularly, there's a great deal here. You get all the movies and everything for free too. TV series Succession is absolutely brilliant. It's kind of roughly based on Rupert Murdoch News Limited, and was started as Australian, but they're American now, on the 20th Century Fox network. And it is all about the messed up dominant family who run this huge media enterprise, and all of the sons and daughter all have their issues, and kind of politely fighting amongst themselves to try and get control of daddy's business, but daddy ain't dying anyway. So that's a hugely interesting one to watch, and I'll give you some other hints subsequently. So I'll set up that forum. Please share that, anything, and it can be some really classic ones, very Shaw kind of things too, about salaryman featured dramas or anything that's interesting, so that we really get thinking about what is the status of the company and corporate life in contemporary culture. Okay, I'll hang around for a bit if anyone's got any questions. Yeah, one thing, the first quiz was 6. The average mark was 6 there. There was enormous variation. Some people got 10 out of 10. A couple of folks got 1, but it's only 5%. Remember, the next time is Wednesday. I'll send you an email as a reminder and everything. And there's 20 questions this time, and it will cover the lecture notes up to today. So I won't cover the liability, and it will be, very importantly, the book up to the end of chapter 3. Okay, really want you to get that reading done, plus also those videos we had from the 2 authors that were linked to last Wednesday. Okay, so that's it, but I'll hang around if anyone needs to ask me anything. Thank you.